Our next guest says that despite weak gross domestic product numbers in the U.S., markets are focusing on earnings more as companies are set to report this week. For more on this, we're joined now by Diana Avigdor. She's a portfolio manager and head of trading at Barometer Capital Management. And as you can see, she joins us now from the Toronto Stock Exchange market site. Diana, happy Monday morning to you. Thank you so much for making a bit of time during your busy day for us. We understand from a note that you wrote recently that at Barometer you hedged your portfolios for at least a brief period of time, then took those hedges off after the results of the first round of voting in France. Take us through your thinking there, and exactly where were those hedges placed?
The anatomy of the last 4 to 6 weeks has been as follows. Over the last year, ever since actually from 2006 February lows, markets have rallied up, and we were fully invested throughout that period. And on every dip, actually, none of the indicators that we're watching have broken, even on the dips. Right before the French election, or going into the French election several weeks, indicators started to falter. Global breadth models have deteriorated, and that to us, from a disciplined, we're very disciplined from the way in the way that we hedge or get out of positions through stop loss. But things were not sinister enough to get out of certain positions. Stop losses were not triggered, but portfolios certainly were hedged to take out any tail out of the volatility of the portfolios. After the French elections, market reasserted itself. It could have been that we would have had a 5 to 7% correction. It's still possible that we might have a correction, but given our disciplined indicators that we're watching, and we just follow those indicators, right now breadth has reasserted itself. Internal indicators that we're watching have reasserted itself. Technology, which has been a leader all throughout actually, and hasn't really broken down, has taken up again, and so have industrial, consumer, financials still need to do a bit of work. So we'll see. Their hedges are off, and we'll see where it takes us.
Would you recommend investors to use hedging more often than not? Certainly with the VIX at a low in the mid-10s, it seems that protection is cheaper. Would you recommend more people be looking at this type of strategy?
That's absolutely right. Hedging, however, will go against your portfolio longs. What I feel is that the indices no longer actually exhibit the actual portfolio that you're holding unless you're in a passive product, such as an ETF on the spiders or XIUs or so forth. If you're holding a single stock portfolio of 40 to 60 names, you will have greater volatility than the index actually. So we do recommend the hedging despite the fact of what you're saying, that the volatility is low. And actually what we've seen on the option desk, as described by global bulge bracket firms, let's say on Friday, lots of call buying in the longer dated VIX because they're so cheap, to your point, yes.
You also, I understand, have been, your position in the Canadian banks has been reduced because of the stop losses that you talk about. Are those the home capital related losses, the sentiment related losses, if you want to call them that, of last week? Are those the losses that the declines in the bank shares that you're talking about?
Well, that's right. So our biggest weights are technology, financials, and financials still up there at 20% in certain portfolios. But we were higher, 25, 28. And, Barometer is a very disciplined asset manager. We have stop losses on every single position. We have specific indicators which lead us to hedge or not hedge. And we follow that discipline. So as the Canadian financials started to falter because of the home capital, or who knows? I mean, we think it's because of home capital. We all think that the global investor is once again trying to short the Canadian banks. They've tried that many, many times. And you know what? A government keeps putting on issues and things into the market. Eventually, they might crack the housing market at some point. We don't see evidence of that in the real estate market, talking to, say, brokers or seeing the home sales. But yes, that's exactly it, Paul. So, as those stop losses trigger, we de-weight and then sell some of our Canadian bank exposure. And so right now our Canadian-U.S. exposure in the bank book is probably more skewed towards the U.S. banks, as those have not really broken down yet.
You touched on technology earlier as one of the winning sectors. Did you have any thoughts on Friday's price action in the market? It seemed notable to me that the NASDAQ actually closed down after having really outstanding numbers from Amazon and Google. And it seemed on the day, like when those companies are up 4 or 5% and the market closes down, that there's something weird going on.
Yeah, I think that there was a bit of profit taking. There was the expectations were so high going into the quarter, and also so many longs into and the weekend. Usually squaring positions. NASDAQ has really outperformed everything else. I think it's up something like 14% year to date. I think that and market was, it ended up positive, but was a little quiet into the weekend. And so I think that it was just profit taking. Honestly, this whole conversation about how 5 of the largest stocks leading the tech market, it's gonna happen that there's gonna be some profit taking. I didn't see anything of value to share in terms of negative news. I think it was just flows.
Diana, thank you so much. Diana Avigdor is a portfolio manager and head of trading at Barometer Capital Management. She joined us from the TSX market site.